All right. Hi, everybody. This is Dr. Manning, and I hope you are all doing very, very well. This video is going to be about two really large, big, important concepts in accounting, and they kind of go together. So the first concept is this thing called T accounts. And to go along with T accounts, we're going to be discussing debits and credits. Before we begin, the main thing I want you to know is that this is just simply a new method of recording transactions. So the stuff that you've learned previously about recording transactions and the accounting equation needing to be equal at all times, and assets and liabilities and owner's equity, that all still applies to this. So we're not changing any of that. We're just looking at a new way to record transactions. So let's get started. So first of all, a T account is a way for accountants to see what is happening in one single account. And it's just called a T account because it looks like a T. I know, brilliant, right? But that's why they call it a T account, is because it is shaped like a T, all right? So the easiest way that I can explain it to you is it's going to be really similar to what we've done previously, where we had individual columns in those tables that we've been recording in. Individual columns represented one account. So we're going to take that column and we're just going to morph it into a little bit of a different shape, and it's going to be a T account because it looks like a T. So here's an example of what a T account would look like. You can see up here across the top, it says the name of the account. This is our cash account, all right? And it's shaped like a T, which gives it two sides. Over here is the debit side, which is on the left. And over here on the right side is the credit side. Now, what does debit and credit actually mean in accounting? There's a lot of misconceptions about this. There's a lot of misconceptions about like what it actually would mean. But to make it as simple as possible, the word debit just simply means left. So it's on the left side of a T account. And the word credit means right. And that's it. Those two words in accounting only mean left and right. Debits and credits, just like the accounting equation, must always be equal. So when you record a transaction, you will always have at least one debit and at least one credit, and those amounts will always be the same. So just like I told you before, that when you record a transaction in the accounting equation, the left and the right side, the asset side and the liabilities and owner's equity side need to remain equal, so do debits and credits. Okay, common misconceptions. The first one is sometimes we get into our mind that one is good and one is bad, but that's not true. Debits and credits are neither good nor bad. They just mean left and right. So those are just two sides of the same thing, basically. Debits and credits are not the same as adding and subtracting. That's the other misconception. When you debit something, you're not adding to it or subtracting from it. And the same thing with credits. When you put a credit into an account, you're not adding or subtracting. You are just simply putting money into the right side of that T account for credits. Or if it's a debit, you're putting money into the left side of that T account. So the sooner you can get this out of your head, that one's good or one's bad, which is not true, or that one means adding and one means subtracting, which is also not true, the better you will be able to understand this concept. One way that I've heard it before, and I kind of like this, this idea, is that when an accountant records a transaction, they are basically recording the flow of money in the business. And money has to go somewhere, and it has to have started somewhere. So accountants consider transactions as being the flow of money from one account to another. If you think of it this way, then the debit is the destination of the money. That is where that money is going. And the credit is the source of the money. That's where it started. So as you record a transaction, you credit where the money once was, and you debit to where it is now. There's no way to like magically create money out of anywhere. And there's also no way to magically delete money out of nowhere. If you were to do that, you would have an unbalanced accounting equation, and you would also have an unbalanced T account. So you always have one destination and one source. Here's an example transaction, and this is a transaction we've worked with previously. Purchase supplies with cash, $100. So the business is buying supplies, and we used cash to buy those supplies. So in this transaction, we would be moving money from the cash account, which is the source, to the supplies account, which is the destination. And if you think about it, that makes sense, right? Because we are going to have less cash than we once did. So we took money from that account, and we're going to have more supplies than we once did. So we're putting money in to that account. If you use the source and destination idea in this transaction, the supplies account would be the debit. It's going to get the transaction on the left side of the T account. And the cash account is going to be the credit. It's going to get the transaction on the right side of the T account. Now, there's this thing called normal balance as well. And normal balance just simply means which side of the T account does an account's balance usually appear? Where is it normally? And we base this off of the accounting equation. So I've written the accounting equation right here. Assets equal liabilities plus owner's equity. Assets are on the left side of the accounting equation, which we learned earlier, debit means left. So assets are on the debit side of the accounting equation. Liabilities and owner's equity are on the right side of the accounting equation, which we also learned earlier, right is credit. Credit means right. So liabilities and owner's equity are on the credit side of the accounting equation. This also works out for their normal balances. Asset accounts usually or normally have a debit balance. And that means they have more debit transactions than they do credit transactions, or more value on the debit side. Liabilities and owner's equity are opposite. They usually or normally have credit balances. They have more value on the credit side than they do on the debit side. If you understand the normal balances thing, then you can also start to understand whenever you receive a transaction on one side or the other, how the value of that overall account is changing. So for instance, let's say we have an asset account. Here's our T account, and this is an asset account. It could be cash or supplies or accounts receivable or any of the other assets that we've learned. If I want to put money into this account, meaning this account is raising in value, I would put it on the debit side. If I want to take money from this account, meaning it is decreasing in value, I would put it on the credit side. Now, I can already hear your wheels turning in your head, and you're thinking, but Dr. Manning, just a moment ago, you told me, here it is again, you told me that debits and credits are not the same as adding and subtracting. And that's right, they're not. They are not adding to an account or subtracting from an account. However, when you look at a normal balance of an account, like an asset, a debit transaction does increase the value of that account. But what about if we did a debit transaction for a liabilities account? Liabilities are on the right side of the equation. They're on the credit side. If I do a debit transaction for a liabilities account, it would decrease the value of that account. So that's why I say this misconception of adding and subtracting doesn't work, because debits are not always adding or debits are not always adding from an account. And they're also not always subtracting from an account. And credits don't always add to an account or subtract from an account. So you can't get into your mind that one means adding and one means subtracting, because it depends on the normal balance of that account. Capital account, or the owner's equity account, acts just like the liabilities account. Because it's on the right side of the equation, the credit side of the equation, a debit transaction for the capital account would be a decrease in value, and a credit transaction would be an increase in value. Okay, thank you for watching this video. I hope that you were able to follow most of it. We are going to have this conversation in class as well. So hopefully, if after watching this video you have any questions, you can remember to ask those in person. All right. Thank you all. See you later.